on the duration. It's dependent on the duration of the investments. So treasury bills are for investments which run between the period of 91 days and then 364 days. That's what we call a treasury bill. On the treasury notes, we are talking about investment securities which run for a period of over a year and then maximum 3 years. So we have a 2-year note and then we have a 3-year treasury note as well. And then we come to the bonds. With the bonds, investment securities running after a period of 3 years and up to on the Ghana market, we have up to a 20-year government of Ghana bond listed. And the government of bond listed. Okay. And then we have the companies or the corporate bonds. With the corporate bonds, they are bonds which are issued by institutions or it can be an institution, not necessarily have to be a company. We can have government institutions still doing that. And then we can have companies like the ones listed now. We have AFB, we have Dachi and all those ones also listed. So we look at the key features of a bond. A bond has a coupon or an interest. When you buy a bond as part of the bond, you are given a specific interest that you'll be receiving periodically called a coupon. On the equity side, we'll call that a dividend. Sort of, dividend is paid at the end of a year when companies declare their profits and then they make announcements on which amount they would like to pay out as dividend. For coupon, when you are buying the instrument, you are made aware what you'll be receiving biannually. So the most basic one is that you will receive coupon payments every 6 months. So in a year, let's say you bought it at the beginning of the year, you receive your first coupon payment in July, and then you receive the other one in the January, making it the full 364 or biannually, like I said. Also, a bond comes along with a maturity date. So when you buy a bond, you are made aware when you are expecting a maturity. So like we made mentioned, we have the treasury bills, we have the treasury notes, and then the treasury bond. So each one comes with a duration, and then you are made aware when your investment in that particular security matures, and then what you'll be receiving from it. There is also redemption or rediscounts. So the maturity and then the redemption is in a one line item, but there's also a rediscount where before the security matures, you end the period of your investments in that particular security, maybe due to reasons known to you. And then there is the nominal value or the face value. So the face value is what you'll be receiving your coupon on. When you bring in funds to be invested in a fixed income security, you'll be given a face value. So the face value is more like the value of the money you are bringing in terms of the price you be paying and then the duration of the investment that you want to hold. So you are given a face value that you'll be receiving at the end of maturity. And that's what's another feature of a bond. And then there is a price. Okay, so the price is basically just like the price of an equity, but with the bond, there's the price of 100. Okay, so let's say 100 cedis. Either you buy it. Okay, so the face value, like Gabriel Smiley says, I should take the face value again. So let me go back to the face value. So face value is when you pay when you bring the funds to be invested for you, okay, you are not going to receive the same funds that you brought in terms of on maturity. Let me say, we'll be calculating the value of the funds that you've brought in based on the security that you want to buy, okay, and then also based on the rates that you'll be receiving. That's what we'll be able to calculate and get the face value for you. So the face value is sort of um, it's just telling you what you'll be receiving at the end of your investment. Okay, the total amount that you'll be receiving at the end of your investment is what we call a face value. I don't know if you are okay with that. So let me go on with the price as well. So the price is, thank you. The price is based at 100. So it's either you are buying it at a premium or at a discount. This comes into play in just because of demand and supply. So depending on the way the market is moving at the time that you want to invest or disinvest, that's when we're going to determine the price and then the duration. Okay. So in that case, let's look at the graph on the right. So there is a risk and return comparison. Okay. So we can see that at the bottom of the return table, we see cash over there. So cash is basically the money that you deposit into your bank accounts or your mobile money accounts, just for safekeeping. That's cash. There's little risk that comes along with keeping cash in your bank accounts. And so meaning, let's say you are giving someone money and you just know that, oh, you can come for it for any short period of time. So the slides aren't moving. Yes, we are still on the particular slide. That's why we are still on the particular slide. Okay, so the cash is what you put in your bank account basically. So you can see that at the bottom of it, you'll be receiving less return if you keep your cash, your money in a savings account as cash. Okay, and then we will move further to fixed income securities. So the fixed income securities, due to the level of risk involved, which is higher than keeping your money in a cash account or a bank account, you receive a higher return than putting it in your bank account. And then at the topmost part of it is shares or equity, which comes along with a lot of risks and then gives you a lot of return for that. So looking at the table on the right, you still ask yourself, why should you buy bonds? Okay, I've tabled down 4 points. So the first point is that a bond is a good diversifier. We are always told that you have to diversify your portfolio just to hedge against losses and all that. So a bond is a very good diversifier in that case. Also, bonds are less volatile than equities because when you buy it, bonds basically work with interest rates, and interest rates don't change overnight like the way equity prices will change overnight. Okay, so bonds are less volatile than equities. Also, there is stable and predictable income. When you buy, you are given a coupon that you will be paid. You are also given a nominal or a face value that you'll be receiving at the end. And also, the duration of your investment. So you are able to plan and make predictions as to how you'll be using your funds or maybe reinvesting them at any particular time. Okay. And then bonds are basically quite easier to trade compared to equities, So these are 4 very good reasons why you should have bond as part of your investments. So we can continue on the slide. Okay, so what affects bond prices? The number one thing that affects bond prices is interest rates. Okay. So let me just put this example across. Let's say you are expecting 10% return or yield on your bond that you are holding, okay? And then interest rates goes up. And then interest rates goes up, let's say the day after or the night after. What happens is that as an investor, you will be expecting to earn something higher than the current interest rate that is on the market. Okay. So in that sense, you will have to be bidding for something which is quite cheaper. Okay. Because if you pay more for it, it means you are the one going to be at the losing end. So you will have to bid for something that is cheaper. Okay, so interest rates going up results in bond prices also moving downwards, because no one will want to buy something expensive when at the end of it, they will not be receiving much in terms of real returns to them. So it's more like an inverse relationship between interest rates and then bond prices. You know, interest rates are, let me go a bit deeper. They are uh, pushed by inflation. So with inflation going up, it's going to eat into cash, it's going to eat into uh, fixed income securities before it gets to equity. So in a way to keep the bonds and then the fixed income securities competitive, governments will have to raise their interest rates to make it attractive to investors. And in that case, anyone who is coming in to buy will want to pay cheaper so that they will be able to earn more at the end of it. So that's basically the whole logic behind it. And then there is the time remaining until maturity. So I hold a security, I've hold it for a longer period, and then it's just left with a short term, maybe let's say a month or 2 months for it to mature. Okay. I wouldn't be expecting to earn more for that period, because let me pick Mr. Kofi as my friend. Okay. And then he comes to me that he wants uh, money to put into his business or anything else. Okay. And then he says he needs it for a period of 3 months. All right. And then my friend Kofi also comes around. Oh, I've used Kofi already, so let me use Kojo. My friend Kojo comes around and says he also needs that same amount of money, okay, for a period of 1 year or 2 years before he can pay me back. So this is two different scenarios. One needs it for a period of 3 months. The other needs it for a period of 2 years, okay. In a period of 2 years, a lot of things can happen. Interest rates can go up, can go down, prices will change and all that. So in a way to make me the one giving you the money comfortable, I will need to have an assurance, okay, a premium on the money that I'm giving out to you compared to someone who needs it for a period of 3 months, okay, or maybe 2 months or a month. So interest rates, the yield that you'll be receiving on your investment for a short-term security tends to be lower compared to a longer-term security due to the risks or the uncertainties that can come in between these two periods. Okay, so that's why you have these treasury bills having lower yields on the markets, 12.52 for the 91, and then 13.6 for the 182, compared to having like 20.7 on the is it a 15-year one. Okay, so you can see the huge difference between the different yields that you'll be receiving at the end of your investments. So we've been talking about bonds. It seems like bonds look like they don't really have a lot of risks, but there are still some risks associated to having bonds. Okay, one is QE, or quantitative easing by government. So, you know, governments have their way of controlling money supply in the economy and all that. Okay, the US government did that when there was the outbreak of the COVID-19. They were issuing, they were printing a lot of money to purchase these securities that were being offered on the market. Okay, there have been news around them trying to reduce this, or they call it being hawkish, cut down on this particular activity. So it's posing risks, as because when they cut down on it, that means that there will be less demand, and then there will be less activity, and then prices will tend to drop, which is not good. So, and then yields will also tend to drop, which is not good. So that's a risk. Also, coupons can be deferred, and issues can go bust, in the sense that let's say usually governments don't have that risk coming around a lot, but with the corporate bonds, like I mentioned, companies also issue bonds and all that. It gets to a time where they will have to deliver on their promise of paying you your coupon, and then they will not be able to fulfill that due to maybe them being cash strapped or something. This phenomenon happened in China with Evergrande. I don't know if any of you heard about it, where Evergrande is a real estate company where they build and then they rent it out, and they also work with issuing bonds to the investing public. And then they had issues with meeting their obligations of coupon payments to their investors, which is a very serious situation in China at the moment. And also, we have the risks of credit rating from these credit firms. Yeah, Evergrande. Maxwell Dankwa. Okay. Okay.
Oh no, so, I was just building on what you were saying. That's all.
Oh, sorry. Sure. Oh, sure. Oh, sure. Sure. No problem. So we will move to yield curve at the moment. But just before the yield curve, let me complete on the credit rating. So the credit rating, we have these big international firms which do research based on the country's economy.
Okay, I think we have a network issue from Godwin. But as I mentioned earlier, you can be putting in your questions, all right? The questions are very, very important.
Okay. Currently, hello, can I go on?
You can go on, please.
Okay. So currently the rating for Ghana by Fitch is B negative. It used to be at B, but we've been given a negative outlook at the moment. Not great, but not too bad as well compared to the rating bandwidth that I just showed you on the presentation. Okay, so let's come to the yield curve. The yield curve, I'm sure a lot of people are abreast with it. So what the yield curve does is that it reveals how fixed income investors see future interest rates. So, and then it can be early indicators for looming trouble. So let's just come down to the three listed curves that I have here. I have the normal curve, the inverted curve, and then the flat curve. So looking at what was stated at the top, that it reveals how fixed income investors see future interest rates. It just boils down to the graph that we have on the right. Okay, so if we are to go with the normal flow where we expect short-term securities to be yielding lower compared to longer-term securities, we will be having what we call the normal curve, the one in blue. So I'm giving you the money for a shorter period. So I don't really have to pay a lot of interest or premium on it because I'm holding it for a shorter period. And you know, I will be able to meet obligations for that. For a longer period, okay, for a longer period, you will expect to be given more since maybe you might have other use for the money, but you are just giving it to government or a company to work with it for all those years. So you will be expecting to get higher. But when we come to the inverted curve, what we see here is that the shorter term securities are rather yielding higher compared to the longer term securities. And this comes along because of how fixed income investors see future interest rates. So if they expect future interest rates to be going down, that's when you have longer term securities having lower rates compared to the shorter term, because in the shorter term, that's what they see, that's what they know. And then interest rates are high, so they will expect to get higher yield for investing in it. But when there are news or projections that interest rates will be going down, you tend to see the longer term securities yielding lower. That's what brings about an inverted curve. And then there is a flat curve when, let's say, you don't expect any change in interest rate and all that. Okay. So let's come to the trading platforms that we use for trading fixed income securities. In Ghana, we use the Bloomberg Terminal and then the Capisa or the Easy Trade. So the GIFIM, that's the Ghana Fixed Income Market, has a well-established information technology infrastructure in the form of Bloomberg e-bond, together with the Central Securities Depository Ghana Limited Clearing and Settlement and Depository System, and in Ghana, Interbank Settlement of Bank of Ghana. So on the right, the image at the top is a Bloomberg terminal. So I hope you can all see it a bit better. So you have two screens on one, just showing the securities on offer on the left. So we call that fixed income quotes. We call that fixed income quotes. So fixed income traders come onto the Bloomberg terminal and then they put out securities that they have available for trading in that particular day. It can be both bid or on the ask side. And then also on the top, you will get to see all the different classes of fixed income securities. So you get to see the government of Ghana, you get to see the corporate bonds, you get to see the Treasury Notes, and all the other ones as well. And then the bottom is the CSD. So I was just trying to get a CSD platform, but I didn't really get it, but this should work. So CSD helps with the settlement of securities on Ghana's trading platforms as well. And they also have their own trading platform that once in a while we use to put in trades. And it may be possible to trade fixed income securities on the bond platform of the GSE Capisa automated trading systems. And market opens at 9 a.m. or 9 hours GMT to 4 p.m. or 16 hours GMT every business day or any other day determined by the Ghana Fixed Income Market in the press release. So maybe unless there's a holiday or something, then they come across with information that we will not be trading on this particular day. But apart from that, we trade from Monday to Friday from 9 and then to 4. So between this period, you have to book your trade. You have to have your back office or your operations team set up the trade, and then you have to execute the trade and then allot to the particular clients before the 4 p.m., which is the close of trading for the day. And then the last slide, I just put the GIF there because I just want to have a general discussion about the Ghana fixed income market. So the Ghana fixed income market has been growing very significantly over the past few years, especially in 2020, where we saw over 100% growth in volumes and then values traded. Also, 2021 saw the same significant growth in activities on the market. There are still a lot of people who are getting to know about the bond market, about how to trade fixed income, and then about the different possibilities and then investment chances that they can get on trading with the fixed income. The Ghana Stock Exchange is even looking at having the Ghana fixed income markets as a standalone institution to also boost the volumes and then values that are traded on the market. So I think it's very good for the fixed income market in Ghana. Okay, it's very good for the fixed income markets in Ghana. It's just a very strong competition to the equity markets, but for the benefits that comes with investing in fixed income securities, we can always say that it's a plus, and then it's a go-to place for investing your funds as well. So I think I will take the questions now if there are any. I saw some questions pop up when I was doing the presentation, so I don't know when I can start with answering the questions. Mr. Kofi.
Okay, Godwin, thank you so much for the presentation. Okay, just as you said, I also saw Emanuela raise her hand. I don't know whether you like to speak. Emanuela.
Yes, please.
Okay, kindly go ahead with your questions. Just ask the questions and all the questions, please. You know, you've been bombarding me with a lot of questions backstage already. So this is Mr.
Yes, yes. Please, my question is related to the risks, which is the credit rating risks. I didn't get it.
Okay, so the credit rating risks, let's say, let me bring it from an equity point, and then I'll put it in the fixed income one too for you to get. Me as a research analyst, I'll do evaluation on a company. I'll do evaluation on a company, and then I will say that, okay, so this company, they look healthy based on their profits that they generate and then their revenue that they've been making. They look healthy based on their earnings per share. They look healthy based on their price to earnings or any other ratios that I want to attach to the company based on the information they've been giving me. Okay, it's the same thing that these credit rating firms also do. So they pick the country's GDP, they pick our exchange rates, they pick all these very important variables when it comes to a country's economic activities. And then they also look at how you've been performing in terms of meeting your obligations to your current or existing investors in your economy. So they do that, and then they look at how they do a projection on how they perceive you to be able to meet future obligations when you come and issue these bonds. So what they do is that basically they can put out a price that, okay, so this country, you should buy it at 5 cedis or 10 cedis. But what they will do is that they will tell you, okay, this country is credible when you give them your funds, when they come and issue their bonds, and then you give them your money. They are credible, and then they'll pay back. Their economy is strong enough to meet any future obligations. So that's what they do. And then they'll put their ratings there. So these international investors too, when they go on these Fitch, Moody's, S&P, when they go on these platforms, they read these ratings and then they make their investment decisions based on that. So the risk over here is that if your country's economy is having challenges, they will put that one out there, okay? And then that will determine how people come in for your bonds. Because if a government issues bonds is to meet their maybe budget deficits or expenditures and all that, if you go and you are not giving the money, it means the government, you are cash strapped, and then you will have to increase your interest rates that you will be giving out. And then, like I may mention, interest rates comes with bond prices going down, which is also not good for people who are existing holders of the bond. As a, you are sort of making them lose out just because you want to go and get fresh funds, which is also not good for the country. So that's the whole mechanism around these credit rating firms, and then how their projections and then their outcomes affect the quality of bonds issued by governments.
Please, I have a
Thank you
question.
very much.
Okay.
Can I go ahead and ask?
Yes, sir. Yes, sir.
Okay, so I'm going to write I'm going to write on Emmanuel's question, right, and ask that and talk about how these credit rating agencies themselves. I think we have S&P Global, we have Fitch, and we have Moody's mainly. You'd realize that they sort of gatekeep the system of due diligence and rating, let's say, the credit worthiness of most bonds. But at the same time, I've noticed an emerging trend, which is there are key financial institutions which trade in securities, which have top analysts who are turning out to also give outlook or projections. We have Fidelity, we have JP Morgan, and usually they restricted that to corporate bonds or corporate assets. But now you realize that even JP Morgan comes out with comprehensive reports on governments and bonds, and sometimes that even affects the outlook. You understand? It's like it's like a narrative kind of thing that is going on, and you find that credit rating agencies and analysts who belong to certain key financial institutions, global ones like Citibank, JP Morgan, and the like, are now almost in a way affecting the outlook of, let's say, governments and their bonds and what's not. Have you made that observation? What's your take on that? Hello, did anyone hear me?
Yes, I can hear you.
Hello.
Godwin. Yeah, Godwin,
Hello?
can hear you now.
Yeah, sorry, I think I got muted because I started speaking, but I think I got muted.
But
So
did you get the full statement? Did you get the full statement?
can you go over it for me, please?
Okay, so I was saying that traditional credit rating agencies like S&P Global, Moody's, and Fitch, they have typically been focused on, let's say, economies, rating economies, and maybe large economies. They focus on corporations. You find that they talk about, let's say, GM Electric and all those things, and maybe they talk about sub-Saharan Africa and how maybe our economies are lagging, or maybe they are rebounding from a recession. They do all those researches, but at the same time, you find that now key analyst reports are coming from big financial institutions that are talking about governments, and this is having an effect on their bonds. I recently came into an article on Bloomberg talking about how a JP Morgan analyst was given a projection about certain countries in Africa, like Ethiopia and the likes. So you'd find that now it looks like credit rating, or the effect of credit rating, which is painting a picture of the outlook of, let's say, the bonds or whatever. It's not really now the of course, officially credit rating agencies do their job, but these key analysts from these big banks are having a say on these matters as well. Are you making this observation as well? What do you have to say?
Okay, so it's about a lot of people, a lot of research people understanding the essence of the bond or the fixed income markets, and then they also having a lot of clients or investors who are interested in knowing about maybe an economy or a corporate firm, because these foreign investors, when they want to come in, after a period of time, they want to read fresh ideas from other research people as well. So, like I said, even you, Mr. Maxwell Dankwa, if you are able to really prepare yourself and then have adequate information, because the information we get from these government where they put on radio and all that, I would say that's one leg of it. But these international firms are able to get the right data, because the government sells a lot of these bonds outside the country. They sell it to a lot of foreign investors, because they are the ones with the dollars to buy these bonds and then help our economy stronger. So for a foreign investor coming in, he'll want to find a lot of research stuff to read about. The good thing is that we are not being limited to these very big three, the Moody's, the S&P, and then the Fitch. We are having JP Morgan. We are even Goldman Sachs does some projections on governments and then corporate bonds as well. So for me, my observation is that it's just about a lot of people getting abreast and then having information, having information that they will be able to make almost accurate projections or conclusions on governments, economies, and then these corporate institutions. So let me put it in a more basic example for you, Mr. Maxwell. So you know of these three, you know of Moody's, you know of S&P, you know of Fitch. You read through, maybe you read through their reports on the Ghana economy. Okay, and then you find an article on JP Morgan. You will want to read that, and then something in that report might intrigue you that you will want to go ahead with whatever projections or recommendations they made, and not what you know from these three traditional ones. So for me, my observation is just about a lot of these firms getting stronger in terms of their research and then information that they are able to receive from the governments that they invest in. I always say that the governments, the local investors, they give us, the information they want us to get, but on the outside world, they give them the real facts and then the real figures, and they are able to give us these strong projections. That's why most of the time we still base our decisions on when we want to invest on the bond markets from these main three or any other report that we might find very insightful.
Okay, so typically they might come out with more thorough research based on their level of access to information and maybe how rigorous their methods are. So it's just a way of
their methods and their research team. Yes.
Okay. Thank you very much.
You're welcome. You're welcome. Mr. Kofi. Hello, Mr. Kofi.
Hello. Okay, so I think we have a number of hands up already.
Inbox, yes.
All right, so let me start with Samuel Ofori. Ofori, you can go ahead with your question. Then when he's done, Kerr is also an invited guest. He also asked his question, and Kwame Lawrence, you are next. Okay, so Samuel Ofori, Kerr, and Kwame Lawrence in that order. Thank you.
All right, thank you, Kofi. Godwin, thank you very much for your presentation. I wanted to know, apart from the interest rates and then the yield curve, is there anything like a sort of a benchmark that can give you a general outlook of the bond market?
Okay, so the general outlook will come from the interest rates. Okay, so you investing in it, your goal of investing in a bond market is to receive the yield on the investment that you are doing. And the investment that you are doing, the yield is going to be determined buy the interest rate. So you buy it, okay? When you buy it and the interest rate goes up, all right, it poses a risk to you, because in interest rates going up, it means that governments will have to increase the rates that they are giving on the market, and you already have the security. Let's say you bought it at 20%, 20% yield for a security that you bought for 7 years. Okay. And then right now, interest rate has gone up. Okay. Government will want to issue the same 7 year. They do reissuance and all the time. So they want to reissue some of these 7 year instruments. Okay. And here's the case where interest rate has gone up. Interest rate has gone up. So someone coming in who don't want to get the same 20% that maybe you received a year or 2 years ago, they will want to get something higher than a 20%, meaning that the security that you are holding now will have to, the yield will have to go up to, let's say 22. Let me just put something roughly out there, 22, meaning that the price of your bond that you are holding right now will come down. Okay. It's an inverse relation, yes. So the price of the bond you have now will come down, meaning that when you're going to sell it, or unless you want to hold it to the end of the maturity, but usually people rediscount in the period of it. So when you are going to sell it, it means you're going to sell at a lower price compared to what you bought yours from. Okay. So from the beginning, yes, you have your coupon that you'll be receiving. That one is okay. But in the event that you want to sell or rediscount, it means that you will have to sell lower than the price that you bought it at, just because interest rate has gone up. But if interest rates were to have gone down in that period, it means that someone coming in will not be expecting to get 20 at a time that interest rate was up, but will be expecting something lower, let's say 18. And then with a lower yield, it means that the price will be higher, or a premium. It means that you might end up selling your investment at a premium compared to when you bought it. So the risk with the interest rate is that it pushes the yields up and then ends up dropping your bond prices, because it's the price that you are selling it at. So the yield and the coupon is there, but it's the price that you are selling it at. And the price is determined by the yield that you will be receiving and then the period that you'll be holding it. And then this is also affected by the interest rate that is prevailing at the period of investment. So interest rate is a major one. The others can be maybe news around the company, or the economy and all that. But even if there is news and it doesn't translate into interest rates going up, or that, it still won't affect your investment. But the moment there is change in interest rates over this period, that's when your investment in a bond becomes at risk, depending on the direction of interest rate in the economy. I don't know if you're okay with that.
Yes, I'm okay. You've answered my question.
Yeah.
Thank you very much.
Yeah, welcome, sir.
Hello, okay, please let me come in before you step in. Kujo, you are the head of the bonds desk. If you are here, I would want to have an input from you. Okay, Ella is part of your team. I've seen her ask a question. Kujo, I've seen you online, so please, when Kwame Lawrence is done, please, let's have an input from you. All right, so okay, please go ahead.
Okay. Thank you very much. Good morning. Please, I would like to ask, with regards to the trading of bonds on the Ghana fixed income market, are you only allowed to go long the bond? That they are only allowed to buy, or you can also go short the bond? And also, I would want to know, are there any derivatives that are gotten from the bonds that can be traded, please?
Okay, so on the Ghana fixed income market, you are able to go long and then also go short. Like you said, it's a trading of investment securities. So it's based on your projections and then what you see coming forward. You might expect interest rates to be going up, so you want to go short and then prevent yourself from the interest rate risks and all that. Or you might see interest rates going up, so you might opt in for more of that security, and then even looking at longer dated ones for that. Your second question, can you go over a second question for me, please?
Yeah, my second question is that are there any derivatives that can be traded on the Ghana fixed income market?
Okay. So the Ghana market at the moment does not trade in derivatives. Okay, but there is the repos market, which is very young or fresh, that we are trying to incorporate into the trading field. But for now, we don't do derivatives on the fixed income market.
Okay. Thank you very much.
You're welcome.
Hello, Kwame Lawrence, if you are there, kindly go ahead with your question.
Good morning. Please hear me.
Yes, we can hear you. Go ahead, please.
Okay. Explaining Maxwell's question, I heard you say something that there are different information given to in Ghana here, and that goes in outside. Yes. I don't know if it should be like that. I want to know.
Oh, okay. You know, government is run by people who are political. So, and information is what you give out to people to hear. That's what they will know. You know, they have a lot of these foreign investors that come in. So then they give information to the IMF, they give information to the World Bank due to the obligations that we owe them. Okay, so these big institutions will be on you. This is not something empirical or scientific, but you know, these institutions, World Bank, IMF, they will be on you to provide a real picture of your country's economy. Okay, they want to see the real figures, because they are the ones that you will be coming to in the long term for these loans and all that. So they want to see the real strength of the economy. And then we have the information where we have information ministers and all that, finance ministers coming up to maybe have a presentation to us on how they see the economy also growing. So you tend to see that when you read these reports that the World Bank and IMF put out about the Ghana economy, and then you read reports that our government institutions sort of also put out on the Ghana economy, you tend to see a more rosy and moderated information from our government compared to what you see from this. So it could be that maybe this IMF and World Banks, they are trying to be maybe too harsh in terms of how they look into the figures and all that. But for my observation, I just believe that due to their obligations they have with these big institutions, they tend to be more prudent in information given out compared to what they will churn out on their either the various political or government platforms to speak to us about the economy. So that's why I was making mention that these international investors, a lot of them, foreign investors, they don't usually base their investment decisions based on what the government will say on a platform or any. What maybe they might base it on is how the political environment is looking. if it's a stable one in terms of the peace and stability and all that. But when it comes to the real figures, they look at the IMF, World Bank, and then these big credit rating firms, because they know they will be on the government to give them good figures, which is really showing the strength or the health of the economy. So, like I said, just based on my observations, so it's not something that is empirically proven, but it's based on observations. When you read these reports from these two different outlets, and then how you see them trying to put out information. Government is still saying inflation will be between their target of 8% plus or minus 2, but we are seeing inflation skyrocket at the moment. December's inflation 12.6 is also very high. And I think this, for me, I believe this trend will continue well into most parts of 2022. Okay, but government is also saying it's going to be moderated. So it's just these two that I'm trying to come across with. Government is saying, oh, inflation will be fine and all that, but on the other hand, you can tell the real picture on the ground. That's what I'm saying. Most of the time, we tend to look at these institutions or these firms for information on how to invest as well.
Okay, thank you, Godwin. I'm seeing a very good question from Fela Manuel. Fela, the question is, we are basically going to do research, okay? And he's asking this question, I'm sure in line with what we are going to do. So what should, hello, can you hear me?
Yeah, Mr. Kofi, I can hear you.
Good. So the question is, what should be looked at to conduct an effective and efficient research on the bond market? What are the things to look at? So this is the question. Hello, Godwin, can you hear me?
Yes, Mr. Kofi, I'm back.
Okay. So did you hear the question?
Yeah, so you are asking about what you look at when you want to have a very effective and good research report on the fixed income.
Yeah, sure.
Okay. So you have to look at the interest rate factor, okay, which will build up from the policy rates that the government will be putting out. So government puts out information on what rates they will want to lend money to these international banks, these commercial banks and institutions in the country. So you have to look at how the policy rates trend is moving in the economy. You have to look at rate of inflation as well, because inflation is also a factor that triggers the trend of interest rates in an economy. So you have to look at the inflation trend in the country as well, or the economy. And then you have to look at exchange rates. Okay, exchange rates in the sense that government issues a lot of these are bonds to foreign investors. They also issue Euro bonds, which are bonds issued in different denominations, as basically the US dollar mostly. So these Euro bonds, when government goes for them, let's say a government goes in for Euro bond when the dollar was 5 cedi to $1, okay, and exchange rates depreciation has caught up with the Ghana cedi, is now at 6.3. Okay, so government in its obligations to the foreign investors will not be paying 5 because they went in for the bond at 5. They will have to be paying at the 6.3. When coupon payments and then maturities come, they have to be paying at 6.3. So you have to also look at the exchange rates, and then you look at general news and information from markets. It can be from government, it can be from even the corporate institutions themselves. Okay, so corporate also issues bonds. So it can be change in management or all those things can also affect how obligations to coupons are met and all that. So I'll go over them again. You look at the MPR or the policy rate. You look at the inflationary figures. You look at the exchange rate. You look at the news around the company or the economy. Okay. And then I'll sometimes also look at the central bank's activities in terms of their open market operations. So maybe they want to have a lot of cash in their system or not. You know, government buys these, government sells these securities to the banks and all that, depending on how they want cash to flow in the economy. So depending on that, you'll be able to know the trend that these interest rates and then these yields will be moving in, and then you'll be able to make good investment decisions on that. So central bank activities can also affect, although they are not very periodic like that. Once a while, they come out with these. They come out with these different market operations to just control the cash flow in the economy. But the ones which are occurring, recurring, and then periodic, that can have almost a constant effect on investing in fixed income is the policy rate, the inflation rate, and then general news around the economy, and then the company, because all of this will boil down into how interest rates will be moving, and then which will affect the curve, the yield curve also. So I don't know if you got the 4 or 5 points I mentioned. Okay. Thank you.
I think it's quite clear. Thank you, Godwin. We'll take our final question, and this is coming from our head of the research, all right, Alassana Jallo. So, Alassana, the floor is yours.
Okay. Thank you, Odoom, for the presentation. So my question is kind of related to insider trading. So I have an experience. I worked at the Ministry of Finance, and then the processes of like the bond issuance, the treasury bills and the bonds. So it's like it's done on a weekly basis. So the government does liquidity forecasting, and then they would forecast their expenditures and their revenues. And then after that, they will establish how much funds they want to raise, and that will be done through the bonds. And usually they would invite all these commercial banks on a meeting to discuss on how they will issue the bond. So if the community are also privy to this information, because it's like you could actually predict what will happen looking at their deficit, and you definitely, and yeah, so is the investing community also privy to this information? And have you encountered any insider trading in the bond market specifically?
Okay, so you made mention of the weekly auctions that they go in for based on the government's projected expenditure for the week or the weeks after, and then they put out the targeted amounts that they are looking to raise. Okay, so you made mention of if there's insider trading and all that. For the rates, when we are going in for auction, you just look at the previous rates. Okay, you just look at the trend that the rates that are being given per every auction, okay, you look at the rates, the trend that these rates are all taking, and then you give a projection whether you expect it to keep on in that trend or not, okay? But that is just one leg of it. You also have to look at the external factors which are affecting the economy at that moment. So let's say there's no news on inflation, there's no news about interest rates going up and all, there's no policy rate announcements, then it means that your projection will be based on how you see the trend in the rates, okay? So let's say you've been seeing an upward trend. It's been going up by maybe 0.08%, 0.05%. Then you can say that, okay, maybe the next auction, if I go in for these particular rates, my bids will be accepted, okay? But in the case where there are news out there, a policy rate announcement has been given, government has increased policy rates, meaning we are expecting interest rates to go up, meaning we are expecting government to bid to offer higher in terms of rates that they want to give out. Then you will be able to also make a projection that, okay, based on these factors, we all expect interest rates to go up. So based on that, I also want to put my base that I'm going in for higher, okay? So for the insider trading, I because it's not recommended, you know, it's not recommended, and then we usually don't get to see rates going out of what we expect, unless maybe it's a new issuance where there are different bids coming in. You know, they give a pricing guidance, initial pricing guidance. So with that, they can come out and say, okay, we are looking at 20% on the yield to be given out. That's not going to be the final one, okay? But there will be people coming in and saying that, okay, they want to give 20%, but based on my analysis and projections. Hello? Okay, so based on analysis and projections, okay, we see interest rates to be going down. So let's just bid lower, okay? Or you see interest rates to be going up, so let's just bid higher. So when all these bids come in around the 20% figure, and then we'll be able to find a weighted average of it, and then we find the real rates that will be coming out in terms of the yield given out. But for you to say insider trading, I think most of the decision is based on projections and then the trend of these indicators that may move interest rates. So it's more like a general knowledge that everyone will be abreast with, because you look at the previous rates, how they've been going. You look at the news surrounding the potential of interest rates going up or coming down, and then you put in your bids based on what your expected projection should be. So you can just go and bid at it's just that your bid shouldn't be too out of the expected range. You know, let's say they say 20% initial pricing guidance, and then you bring something like 26%, you know, or you go somewhere like 15%. Usually people want to go 20.5. They want to do some 50 basis points or some 100 basis points just to have a very good bandwidth between which, you know, like I said, interest rates don't change overnight like that. So it's not something that you expect it to be that volatile. So you'll be expecting more from it, but you just want to be realistic in your projections as to how you see yields to be at.
I think we've had a lot of questions. Maxwell had a question, but we've made I think more than an hour here already. Maxwell, I would like you to put your question out. You can send it. You send it to me. I'll link you up with Godwin so that you can have further discussions with him. I beg you, Maxwell, because we've had a longer period than expected. I would like to thank Mr. Godwin Odoom. Godwin, you've done very well. I'm very proud of you.
Thank you. Thank you, sir.
Done very well. So basically, I think we should take some points home, right? The interest rates, the foreign exchange, the hard currency, how the forex works. We have to be very abreast with it, right? Because if for the way our economy is, there's no way our currency is going to appreciate over a long period against the foreign currencies. So whatever it is, the cedi will depreciate. And whenever the cedi depreciates, it affects inflation, all right? So far as the cedi's depreciation, inflation will go up because most of our stuff are imported. And you can't have things that are imported on a depreciated currency and come in to lower the prices. So basically, price will go up, inflation will be affected, all right? And inflation chases what? Interest rates. So all these things, they are linked, all right? So once you have the idea about these mechanisms, how they work, I'm sure you understand the bond market better, all right? Just as I said, we won't remain on our decks for a long time. We'll be rotating as we move along. And we want all of us here to be very good in analysis, in understanding the financial markets as we have in this country. Then we'll see whether we can move beyond what we have. We have some of us who are always studying. I watch your statuses and I know the things that I see. Somebody like Kerr, always posting international market information. And I'm very, very interested in those things, interested in students who like to be fishing out for information. And that broadens the knowledge of what you already know already within the confines of our financial market. So let's do a lot of research. Let's do a lot of reading. This knowledge, you cannot be sitting there for it to come to you. You have to read to earn it, all right? You need to acquire the knowledge in this field. I'd like to say thank you to all of you. The number that I'm seeing here is very impressive. It was 22, 20, and it's now 20. I think it's very, very impressive. All stayed in till the end. The head of the bonds division, the bonds unit, Kujo, had to leave because he had to attend to another meeting somewhere else. So he would have asked his questions on the platform. I am grateful to all of you. You can send me your questions so that I post it to Mr. Odoom for the necessary attention to be given to it. All right, so thank you, all of you.
Thank you, Mr. Gofiche.
Thank you, you are welcome.
Thank you very much.
Please, I'd like
Thank you
to
very
have
much.
Is somebody asking the question again?
the recorded version of them.
Okay. It will drop
Okay.
it. I'll make it available. All right.
Thank you very much for
I
the
also
question.
like to get
Okay.
Godwin's number as well. So I'll
Okay.
link up later for that.
All right. Sure.
Okay.
So Godwin, looks like you'll be very busy going forward. These are my people, Charlie.
Yes.
Right. Thanks to all of you.
Okay.
Thanks. All right. Bye.
Bye.
Bye.